Good evening. This is Duane Lowry for the DPP Grain Desk for the Sunday Night Grain Outlook commentary on Sunday, November 13th. Tonight, we're going to talk a little bit about what factors are going to move us tonight, but I want to spend quite a bit of time tonight focusing on some bigger picture thought processes. First of all, as far as tonight is concerned, weather's not much of a factor. U.S. harvest is pretty much virtually complete. South American harvest is, South American weather is favorable, acceptable. There's no real concerns there, and weather isn't really having any influence on a day-to-day basis in the grain price discovery system anyway. Technical conditions are troubling from the standpoint we are building selling interest above the market. Short-term perspectives, the market's sold off pretty hard here in the last 3 trading sessions, probably 30 cents in corn, almost 50 cents in beans. The wheat's taken a tumble. Late Friday you had wheat recover about a dime. So I wouldn't be surprised that we'll see some attempt at some early wheat strength. The trade in general has never embraced selling the markets all the way going back from the August peaks to the early October lows to the recent sell-off. There's just never been any embrace by the trade whatsoever to consider the short side. Producers are holding a large amount of unsold inventory, an unusually large amount of unpriced inventory for the end of harvest wrap-up, and that's going to be an anchor over prices, I think, as we move forward. Short term, the CME said they're going to put up $300 million to try to help guarantee the movement of MF Global funds back to the customer and move to their customers' new clearinghouses, and we'll see if the bankruptcy trustee will allow that and how they respond to that. But some will be encouraged by that. Some will think that the lack of the customer funds moving back to the customer has kept trade at a minimum and had a negative influence on grain price movement. Maybe, but I don't think that's been a big impact. But some people will see that as a boost and a reason to call grain markets a little higher tonight. We certainly have some room to bounce, but selling interest in corn is going to be found 5 to 10 cents above where we closed Friday. Selling interest in beans is going to build 10 to 20 cents above Friday's close, and the overall outlook, I think, it looks concerning. On a bigger picture focus, I want to talk about the austerity moves that are going on across the globe. The bond traders have had different countries' bonds in their sights, and they just seem to rotate from one to the other, trying to force these countries into addressing their debt issues, developing austerity plans, cutting spending, etc. Italy's got a new government now. Greece has got a new government now, and they're going to implement plans to cut spending, increase revenue, and none of that is positive for global economic growth. And I think that's the backdrop that we're going to have probably for the next 12 to 24 months on a global economy. And that slowing down of economic activity is not favorable to commodity prices. That is not a good thing. The corn market in the grain trade has been the traders' primary focus, and that's the market they've been most willing to be long and least willing to be short. If you look at what's happened in the corn market, we've had the crop size reduced again last week in USDA's projections, but yet the market couldn't respond to that. The carryout levels are still adequate. Traders are beginning to look at 2012 and imagine more total crop acres, less CRP, and then they start looking at profitability, and they see that corn is still probably the most profitable crop out there for anybody that has the opportunity to plant corn. So they're starting to look at very large acreage ideas for 2012 already. After having 2 years of subdued yield trends, you get traders to begin to imagine something more closer to trend line versus what we had this year, and all of a sudden you're looking at a building carryout situation, not a positive price development. You also got the global wheat values very competitively priced against corn. That's displacing U.S. corn exports. There's even been confirmed reports of foreign wheat being booked to move into the U.S. to displace U.S. domestic corn use and feeding rations. And whether Whether that's a significant item or not, it is definitely a statement that U.S. and global prices don't have much room for current prices to work higher. If you're already at a price relationship that allows foreign wheat to be shipped into the U.S. and compete with domestic corn into the feeding markets. So that's not a good thing. If you look at the wheat-corn relationship, for months it's been priced in a manner to displace U.S. corn, and it appears to be on track to stay in that type of competitively pricing against corn probably all the way into spring or early summer, depending on whether there's any type of a weather concern associated with U.S. or global wheat next spring. Until that happens, the wheat-corn relationship is going to be at a level that's going to maximize displacement of U.S. corn demand, and that is not a good thing. U.S. export demand on beans is well below last year, well below projections. China's import pace has been slower than expected. South American supplies are going to be very plentiful and excessive given a normal growing season there, and so far there's no concern whatsoever with weather. So these are factors that look to impact us in the weeks and months ahead. And I think that it's very important that producers keep in mind that the slower economic outlook for growth for the next 12 to 24 months is not going to be a favorable thing for commodity prices. So when you look at what the market has done here in the last few weeks, traversing sideways in corn, failing in beans and find ourselves back towards the lowest levels we were at during the harvest season with downside vulnerability more to go, and the corn market unable to respond to a positive USDA report last week, you have to ask yourself, is it possible that since the trade has never embraced any bearish stance on corn, is it possible that we have to absorb that type of selling before this market is ever really good? And is it possible that the market has to discount some of these negative implications that they've been unwilling to embrace for basically all year? Does the market have to embrace that again and get clean, so to speak, before there's a chance at recovery? I think there's legitimate concern with that. If you look at corn for the harvest time lows, that's about 60 cents below where we are right now. At a minimum, I'd consider that to be downside risk. For the market to be able to go through those lows by 20 or 30 cents would not be an unreasonable possibility. So if there's a rally coming in the corn market, it's possible that doesn't even manifest itself till spring or summer. And in the meantime, producers are looking at a minimum of 60 cents downside risk. I think from a business perspective of seeing what type of profitability currently exists and recognizing what that downside risk is, there are business reasons to take price protection. Yet, for all practical purposes, nobody has been willing to do that, and I don't sense anybody's willing to do it now. But I still think each individual needs to look at that as a position of respect and to fear that downside risk and try to take measures to avoid being caught in that type of a trap. So as far as tonight is concerned, don't be surprised that we see some early week attempt at strength. There was nothing happening in outside markets that should be a drag on the grain markets here tonight, initially anyway. And so we might see some recovery. But on the bigger picture, short-term strength this week still needs to be evaluated for the merit of being a selling opportunity, especially for producers, and try to remove some of the risk that they currently have with large unsold inventories. For the DPP Grain Desk, this has been Duane Lowry. Thank you.